Got your eyes on a home? You'll need the local home loan experts at Guaranteed Rate Affinity. We are a fintech mortgage company that streamlined the home buying process. Our loan officers have direct access to the best real estate agents, giving you a completely seamless home buying experience. Featuring the industry's most advanced tech platform and customized loan solutions, our local loan officers can help you at any time from anywhere. Our digital mortgage and power bid approval will get you pre-approved in minutes with a strong offer even against all cash offers. You need speed to win in this market, and our same-day mortgage delivers, getting you approved in as little as 1 day. Getting you on track for the closing table in as fast as 10 days. Speaking of the closing table, our flash close options shorten the closing appointment from hours to minutes, or skip it altogether. It's your choice. We've made the home buying experience as fast, simple, and awesome as possible for countless others, and we'd love to help you next. Get pre-approved today with the experts at Guaranteed Rate Affinity, and let's get you home.
All right, good day, everybody. My name is Frank Chardelli, and I'm the Senior Vice President of Sales of Guaranteed Rate Affinity. Our larger mothership is Rate Inc. Many of you are familiar. Guaranteed Rate Affinity is a joint venture outside of Rate. But we have the ability of really making some great connections around the country with so many of our great referral partners and agents, financial planners, attorneys, and then all of our great loan officers that you can find at Guaranteed Rate Affinity all over the country. And from time to time, usually at least once a quarter, we love bringing you these kind of calls to give you some of the background of what is going on in the market, really pertaining to mortgage banking and real estate. So today, really excited. We have one of the top capital markets leader in the entire country of all lenders, Jeremy Collett. And I know Jeremy gets embarrassed when I say that, but it's true. So we're very excited to have Jeremy really bringing us some very informative, topical insights as to what is happening and then what may happen, in the next few days, few weeks to come, to really get all of us to understand how we can better talk to our borrowers, our consumers, our clients, and really help them make great financial decisions, and hopefully trying to get them excited about the path of homeownership, which is definitely still considered a really great American dream. And we want to do our best to provide that at the easiest, highest level possible for all of our borrowers. So with that, Jeremy, thank you again for being a part of this call and sharing some of your insights that you get with so many of the large lenders out there, Fannie, Freddie, Ginnie Mae, the hedge markets out there. You kind of encapsulate all of that and help us to figure out what is the next move. So we rely on you, obviously every day for the betterment of our loan officers and getting them educated. So thank you for doing this. And why don't we just get this ripped off right now and move on to the next one and talk about market events.
Yeah, sure. Thanks, Frank. I really appreciate the kind words. And yeah, I mean, it is the best job in the world. I actually majored in economics in college at the national champion University of Florida Gators. But I had a minor in history because I just absolutely love the way that all of the events, kind of happening around the world, were impacting the markets, right? And I feel like I've had a front seat, to the business and everything happening across the globe for the last 25 years. It's been amazing, which is why I always like to start with this chart. This is I put this together probably at the end of last year, and it's a kind of here's what rates are and here's how we got here. And if you'll notice, we're sort of starting now in Trump's first term as president back in 2018. The financial crisis is now no longer on this chart, which basically means I'm getting really old. But just going back to Trump 1.0, you had a lot of uncertainty, not that different than what we're seeing today. because of the U.S.-China trade war. Obviously, Trump and Trump 1.0, one of his major, I guess, administration's agenda items was to retrade, the U.S.-China trading agreements. And tariff talks first came in there. Of course, now, they're more holistically applied to the entire globe. But what we saw back in 2018, and this was, even leading up to the pandemic, was a pretty substantial bond market rally that took interest rates. And we're looking at the 10-year yield here, which is the U.S. Treasury 10-year, the yield on that. We should probably replace this with mortgage rates at some point, but mortgages are correlated enough to the 10-year where you get the point here, right? So the 10-year yield back in 2018, on the onset of all this U.S.-China trade headline, noise, really sent yields lower, and that typically happens in times of uncertainty, in times, where the economic outlook around job growth and economic growth and prices, are more unstable. So investors typically sell things that are riskier, like stocks, which are more sensitive to economic growth, and buy safe haven investments like U.S. Treasuries. As a matter of fact, and this is a key theme of what's going on today, as a matter of fact, U.S. Treasuries and mortgage-backed securities are amongst the considered the safest investments in the world, right? And the U.S. financial, the bond market has essentially held that status, for as long as I've been alive. So as more uncertainty unraveled, you see yields go from 3%, into the 2s, and then of course, right there, that second bullet, March 2020, the pandemic drops. The Fed, shortly thereafter, cuts rates to zero and starts quantitative easing, which means they're using their balance sheet to buy Treasury notes and mortgage-backed securities to essentially create that back bid, which will ensure rates are going to stay low. So we refer to that period as, the pandemic markets, or in our world, it was a refi bonanza. But rates, for the most part, stayed really low for a couple of years. 2020, we saw the Fed rate at zero. The yield on the U.S. 10-year note was below 1. If you adjust that for inflation, we essentially were producing negative interest rates, adjusted for inflation, that is, maybe not on the screen. And then, as the pandemic, sort of made its way through, and inflation started to rise, which it ultimately did rise to 40-year, highs of inflation. You see rates go all the way from below 1, and the 10-year went all the way up to 4.5, which of course, as you guys, all remember, because we had several really large bank failures that were orderly, but failures nonetheless. That led to the March 2023 U.S. regional bank crisis. So high rates means bond values, which are inverse to interest rates, were much lower. So you had the combination there of negative deposit growth in banks, causing them to sell assets that were basically, at a huge loss into the market. And that caused the failures of First Republic and Silicon Valley Bank and a few others. And then, obviously, we've made it through the pandemic, the inflation crisis, if you will, the U.S. regional bank crisis, little crypto noise with FTX's failure, and massive, uncovering of the fraud that was going on there. And we kind of get into modern times, right? And obviously, the line in the sand now is not just the Trump inauguration for his second term as president, but something we're calling, and we can skip to the next slide there. So this will be the next bullet that gets added to our timeline, but Liberation Day, right? So on April 3rd, from the Rose Garden and the White House, President Trump essentially announced reciprocal tariffs on any country, charging the United States a tariff and trade. and that also included a 10% minimum tariff for every country, right? So if you look at where rates were, the 10-year had been grinding, slowly lower leading up to Liberation Day, and the 10-year was right around 4. After the announcement, obviously, the announcement of all these tariffs, especially at a time where the market's, sort of readjusting to 40-year high rates of inflation, and the Fed's fight against that by raising rates, 13 times or whatever it was, the markets were in flux, right? Like I think Liberation Day and the announcement of tariffs and reciprocal tariffs just really caused a large spike in apprehension around, the trajectory of not just prices, right, and inflation going forward, but the overall economy, not just in the U.S., but even in developing markets around the world. Truly is a global phenomenon. So you saw 10 years try to find equilibrium, right? Initially, we saw a really good rally in the bond market as investors came in to buy 10-year notes and treasuries and mortgage-backed securities. And the 10-year actually got into the 3s for one day. I believe the low officially, because it was during the trading day, was around 390, but I think it even dipped a little below that. And then obviously that was before everybody kind of took a step back and said, whoa, what is this actually going to do to the U.S.'s standing as this safe haven for investors to seek, in times of uncertainty? So you saw yields shoot way back up to 4.5. And we can skip to the slide there. I just wanted to kind of give you an idea of what happened in Liberation Day and sort of where that stands in the overall kind of timeline of where interest rates are and why. So, a quick update, just that's what this slide's designed to do. Over the past week, we saw, we definitely saw some deterioration in economic data. These are things that I think most of us are expecting as we really think about what the impact of tariffs on a sustained basis are going to be to the economy. But if you're thinking, we're going to see probably slower job growth, slower consumer spending, slower hiring, slower demand for services and things like that, I think that's generally what the market expects. So we did see some weaker data last week, JOLTS job openings, and this was the number, if you remember, over the past couple of years, where there was always 10 million, help wanted ads out there. So that dipped down to around 7.6, and then last week that fell to 7.1. So again, there's still 7 million job openings in the United States right now, obviously with deportations and things like that. And the slowdown of immigration, that would kind of hedge, I think job posting losses, if you will. But 7.1, regardless, is a lower number than the 10 we were looking at a couple years ago. GDP came out lower and lower than expected at, I think, -0.3 for Q1. We were expecting -0.2 in Q1. ADP employment change showed slower hiring by customers of ADP, who's the largest payroll services provider in the United States. We also saw slower ISM manufacturing, and initial jobless claims went up a little bit last week. What was exceptionally the opposite of that, however, was the employment report for April. So for the second or third month in a row, we had a really strong employment report on Friday. The employment report's part of that Fed dual mandate, which they use to address monetary policy, that and inflation, right? But non-farm payrolls came out stronger than expected, notably stronger than expected at plus 177,000 versus the consensus estimate of 138. So after that round of weaker than expected data last week, I think the market was really looking for something like 110 or 120, so even lower than economists' estimates. But when we had a much stronger than expected employment report, we saw a pretty sharp sell-off in the bond market last week, that took interest rates from, say, 420 up into the 430s last week. And I'll get into why that is. I've got a section here just talking about the rate forecast and the Fed. But other than that, the other pieces of the report last week were all kind of normal or strong. The unemployment rate stayed the same at 4.2%. Wages actually grew to 3.9%. Not back to the pandemic levels or post-pandemic levels, but definitely approaching that. So, like, I think where we're at right now is you find rates in this range from, call it the 10-year 420 to 440. Mortgages are in the mid to high six, on the 30-year side. But overall, there's some indications of weakness, but they're not really rooted in, I guess, what the Fed's looking at, which is inflation and, of course, the employment rate, employment report specifically. New job growth in the non-farm sector and the unemployment rate. Those are the two big ones to look out. So I got more next. We jump into the Fed, but Frank, you have any questions there?
A couple of questions just about the connection to tariffs and inflation. And I think that's a great question because I guess depending on sometimes who you listen to in the media, there's definitely conflicting insights. And what I get excited about these kind of calls is that we have someone on this call who's just looking at the data and analyzing, how to interpret these kind of things from a strategic standpoint for interest rates. But Jeremy, any kind of ideas how tariffs and inflation kind of work either in favor of interest rates getting better or worse?
Yeah, look, I mean, that's a great question. And to be sure, a lot of the headlines, particularly after the Liberation Day announcement, I think were really served the purpose of spurring a lot of volatility, giving the talking heads on TV a lot to talk about. The market, though, admittedly, is sort of back to a little bit of, what I would call sort of tariff fatigue, right? Where we've really gotten used to seeing a lot of the back and forth from the headlines. And, you see that in the stock market, and you see that in interest rates where they're all kind of mean reverting. Every time Trump says something, or President Xi or Secretary of Treasury Bessent, it's not like we're getting a big volatile swing every day like we were 5 weeks ago and 4 weeks ago. So, but to answer your question, the impact of tariffs is unknown, right? And I think that's what's so interesting about tomorrow's Fed announcement. So we'll just get into that right now. But for this week, tomorrow's Fed announcement is the main event. Not to disappoint everybody, but I don't believe we're going to see a rate cut tomorrow. In fact, I'm looking at on my Bloomberg in front of me here, Fed futures are only giving it about a 1% chance of a cut tomorrow. So I think a cut in the May meeting is off the table. A cut in the June meeting is off the table. And I think the main reasons there are it's just too soon to tell, right? I think Jerome Powell and the rest of the board of the Fed governors, the folks that vote on monetary policy at these meetings, they really have secured themselves into this sort of wait and see posture. And until we see something like inflation fall out or the unemployment rate, go much higher, or even like consumer spending or GDP really fall out of bed versus expectations, the Fed really doesn't need to do anything right now. If you've traveled lately, gone to a restaurant, sat in traffic, whatever, people are out spending money, and the consumer's very healthy. There's still over 7 million, John Wanted ads. So we're not at that point where the Fed really needs to do anything, despite us wanting it and President Trump, of course, calling for the Fed to cut rates. So, my expectation is we don't actually see a Fed rate cut until maybe September. The market's sort of written off the chance of a rate cut in July already, or sorry, June, I should say. July is trading at closer to 50-50. So September looks like enough time for the impact of tariffs to kind of wash through the economic data. But that's exactly where we're at right now. So tomorrow, don't expect a cut, but maybe Jerome Powell during his Q&A in his press conference will tip his hat to what they're thinking about, the Q1 GDP number or the strong employment, report that we saw on Friday. Give us some kind of, inkling of where rates could go and what it would take to move markets, right? So the Q&A and the press conference kind of always take precedent over the Fed decision, especially under, Jerome Powell's leadership as chairman. There haven't really been very many surprises. They've telegraphed pretty much everything they're going to do. But that's the big one of the week. Otherwise, this week's pretty slow. Let's see what else. Yeah.
What kind of, one of the things, it's not so much even about the Fed announcement about rate cuts or rate hikes. A lot of it depends on those kind of questions that Jerome Powell gets after the Fed decision, maybe about what he's thinking, what led up to that decision, or what decisions might be happening, or what they are looking at in terms of a gauge. And I'm just always curious, being at the level that you're at in this industry, what are some of those key things that you would like to hear Jerome Powell say, during his questions and answers, that would give you kind of maybe some optimism that there might be, some relief with rates?
Yeah, I mean, look, I don't think anyone's going to strong arm Jerome Powell into, making cuts when he's not ready. It's really going to come down to data dependency. And unfortunately, for that to actually happen, we've got to let this data come out. So on the chart right here that we're looking at, we're all accustomed to thinking about inflation in terms of CPI, because that's what CNBC puts on TV. But this core PCE index it's just another price index that comes out on a monthly basis. But this is the Fed's preferred measure. So I think it was at 2.8% last month. The Fed's target's 2, so it's still above the Fed's target. They're not going to cut rates until this starts to get closer to 2, right? So that's one of them. I think if you flip to the next slide, this is the second part of the Fed's dual mandate, if I'm correct, employment, right? So price control and assist the economy with monetary policy of running at full employment. So at 4.2%, even though you see a little incline going back from 2022, where the unemployment rate has gone up about 0.7 of a point, it's still historically really, really low and well within the Fed's definition of full employment, right? So until you see these two indexes that I just showed on the screen sort of flip over, the Fed really doesn't need to do much. So I think that's what Jerome Powell is going to say. Not all that exciting, but if you ask me what's going to happen tomorrow, that's it.
Yeah.
And then let's see what the next slide is.
Yeah, I'll be curious to see Liberation Day, was the start of the second quarter. Personally, it seems as though there'll probably need to be that full second quarter to see how things play out. And maybe to your point, like in early July, we'll start getting some data as to how tariffs have affected kind of the economy, inflation, and employment.
Yeah, absolutely. Yeah, we can go to the next one too. So I just kind of covered that. So yeah, just like looking ahead, right? It does feel, like I said earlier, markets have sort of stabilized in a range. So the 10 years trading right around 420 to 440. So we've taken that like 450 to 460 out. We've taken that obviously under 4% out. Stocks have rallied back pretty nicely. And a couple things have happened to kind of take that place. Like I think Trump backed off of the fire Jerome Powell rhetoric, right? So everybody saw that headline. The other thing is, every country besides China, it does seem like there's some positive headway being made with, trading agreements with India. Canada and Mexico are kind of in their own league. But certainly Europe, and Japan. So I think there's been some positive momentum, and like I said, the markets aren't swinging like they were as a result of every tariff headline. And then, Bissett, he's the U.S. Secretary of Treasury under the Trump administration. He also came out in April and said, look, the reciprocal tariffs that they announced on Liberation Day, April 3rd, was kind of the worst case scenario, right? So that really assured markets of like what the downside risk is, right? So I think the combination of, positive headway, sort of defining what the absolute worst, you're going to see out of these tariff discussions, and then and then some of the other things that have been going on, you're seeing markets sort of tuck back into range. So stocks have rallied, Dow's up a few thousand points since the worst. You can see that there. So the Dow dipped below 38,000, shortly after Liberation Day. Now it's back above 40. The 10-year, like I said, has retraced from 450 plus to 420 and 430. So I think that's the theme. What to look out for? There's other parts of and this is the last slide, I think, but one thing to look out for is there's other parts of the Trump agenda, right, that are potentially pro-growth and pro-economy, right? And something that, I'm sure everybody here could use is a tax cut, right? So we don't know yet what the budget proposal, when that's going to wrap up, and what the tax cuts are going to look like. And there's obviously uncertainty around the debt ceiling. If you ask the House of Representatives, they think they'll have a deal by mid-June. Bissett, of course, appropriately came out with July 4th is his target date. And then the Senate believes it'll happen later in the summer. So you've got a good 3-month window there of when all these tax cuts that would definitely be pro-growth. I'm not saying they'd be enough to offset the downside impact or risk of the tariffs, but certainly I think tax cuts are going to be good for the economy and spur growth to some degree. So you could see why, with all this up in the air, it's probably smart for Jerome Powell to kind of retain this flexibility on data dependency, especially with the mixed data that we've been getting, right? Like inflation's still sticky. The employment market seems fine, though there are some cracks starting to appear in certain numbers. The consumer's still strong, though. I can tell you that. So long term, like, where does that get us? I think the Fed, and this has been dialed back quite a bit. 3 or 4 months ago, we were probably expecting about 100 basis points of rate cuts by the Federal Reserve this year. Right now, the market's pricing in just about 75 basis points of cuts. I, for one, and I don't know about you guys, but like, even in the face of relatively high interest rates, at least throughout my career, consumer spending and consumer behavior in general has just been impressive. The consumer is really able to just keep spending through all these cycles, right? And in the pandemic, it made sense because rates were at zero and mortgage rates were cheap and everything else. But where we are right now, I believe in American consumerism. So I've kind of dialed my rate cut expectations back to about 50. That puts the 10-year in sort of the low 4s. I would say mortgage rates, at best get into the low 6s by year end. But that 6 3/8 kind of area on a fixed rate is definitely doable. As far as I can see. The good news, though, is we are seeing sort of a resurgence of some products. Namely, I think jumbo ARMs are there, right? So if you're looking for opportunities as a GRA loan officer or even a realtor, like, that's the ARM market really kind of drives that jumbo demand from consumers to buy homes, right? And like I mentioned earlier, and I love this chart because a lot of times it just sounds like I'm saying stuff and, you don't know if there's anything to back that up, even though I talk to all of these banks, and we're the only capital markets area at a mortgage company in the country that has a dedicated bank sales group. And that's all this team does. They sit right there with our trading people and the folks that set rates, but they just call on banks and credit unions and go visit them. And, they remain, top of mind and when they're ready to put some money to work. And that's primarily driven by deposit rates, right? So if you think about what a bank does, you, Frank, put your money in a bank to a bank that's a liability. Ideally, they pay you some form of interest, although it's probably not what you deserve, right? And then they take that money and they go buy assets. And the spread between the yielding asset, the yield on the assets, and what they're paying you to keep your money at their bank is net interest income. Well, a big part of the regional bank crisis of March in 2023 is just the complete collapse of deposit growth. And you can see this on this chart, right? So obviously, as rates were zero, people were cash out refinancing their homes, and the government was sending out stimulus checks and all that. There was a lot of liquidity put into the market, which people deposited into cash, into bank accounts, right? So you can see there were quarters with over $1 trillion of net deposit growth, right? Right there in early or kind of mid 2020. And then that steadily fell until we saw negative deposit growth in, somewhere around the second quarter of 2022. So it's taken a few years to work out of that. It obviously took a few banks down with it, but fast forward to sort of late 2023, early 2024, 4 out of the last 5 quarters, we've seen deposit growth at banks, which means they've got to put that money to work. And banks really, really like adjustable rate mortgages. It's like that's kind of their their mainstay. So if you flip to this on the other hand is the quarterly change of loan balances at bank, and all this data is available through the FDIC, who insures banks. But you can see loan growth has kind of flipped too. In 2024, the tail end of 2023, after suffering in right around 2021, it looks like. So we're seeing that as an originator, specifically in jumbo. And the good news is we did about $1 billion of jumbo just last month, and about 70% of that was in adjustable rate mortgages with pretty low rates. I mean, there's probably about a 50 basis point difference between 30-year fixed rate jumbo mortgages right now and sort of this bank profile arm. So we did a bunch of it last month and the month before. And as this deposit growth story continues to develop, and it's probably going to be aided by uncertainty about the economy, right? Like as bullish as I am about, the American consumer, folks typically try to save a little more money and put it away in the bank when the economic outlook is uncertain like it is right now. So we could see sort of a sustained arm bid from depositories going forward. So that's great. Like if you're not familiar with our ARM products, we have the biggest retail origination franchise in the country in jumbo. We have great partners all across the nation, big, small, regional banks and credit unions that are buying ARMs. So that's definitely a growth story. We did, 600 or 700 million of it last month. And then non-QM, I mean, we just changed, or we are, so this is sort of an announcement, but it's going live as we speak. We're changing all of our what's called non-QM mortgage products to rate portfolio. And we're just rebranding them and re-teeing up the marketing to where it's more appropriate for customers. So customers don't know what non-QM DSCR is. I mean, that just sounds like some kind of disease or something. And it definitely sounds like some kind of descendant of a subprime product. So now that's like rate investor, rate assets, rate bank statements, all in the rate portfolio of products. We're up to, I think we did $500 million in non-QM production, which is now rate portfolio. And as our loan officers start to adopt it, our realtor partners understand how they can use those products to fund more business that they didn't think they could in the past. We're seeing really meaningful growth there. So, you got two choices right now. And this is something that our team in capital markets thinks a lot about, like, where are we going to spend our time and energy, right? We're going where the business is, and it's non-QM, it's jumbo, it's, home equity products are big right now. Renovation is growing as people sort of have, they're rate locked out from a pandemic refi. So there's massive growth in non-agency products now, and it's grown to about 30% of our business, and continues to climb. So definitely, if you're an agent, talk to your GRA loan officer about the opportunities there, about our ARM rates, and about everything else that's sort of growing in this market, even though rates are expected to be higher for longer.
Great insight. And remember, reverse mortgages are game changers for those that are at that back third of their life. Reverse mortgage. I don't know if there's a loan product that has existed that has given people's financial freedom literally back to them, especially when they're maybe on a fixed income, or some major life changes happen. So reverse, there's lots of great. What I would love for everyone to do, please, you're a guaranteed rate affinity loan officer, knows about all these products. We coach and train pretty regularly and consistently about all these new options for you and your clients to find a house that works for them, get a payment that works for them, and we do the best at bringing them home and help them get again some a piece of some American dream going on. So Jeremy, I really appreciate all your insights, and everyone, thank you for the questions and for the attendance. Again, my name is Frank Turtelli. I'm the Senior Vice President of Sales at GRA. And if there's anything that I can do or help you out with, please let me know as well. And everyone else, have a great rest of your day. And Jeremy, take care, and thank you to you and your team.
Yeah, my pleasure. Have a great day.
All right, thank you.
Got your eyes on a home? You'll need the local home loan experts at Guaranteed Rate Affinity. We are a fintech mortgage company that streamlined the home buying process. Our loan officers have direct access to the best real estate agents, giving you a completely seamless home buying experience. Featuring the industry's most advanced tech platform and customized loan solutions, our local loan officers can help you at any time from anywhere. Our digital mortgage and power bid approval will get you pre-approved in minutes with a strong offer, even against all cash offers. You need speed to win in this market, and our same-day mortgage delivers, getting you approved in as little as 1 day. Getting you on track for the closing table in as fast as 10 days. Speaking of the closing table, our flash close options shorten the closing appointment from hours to minutes, or skip it altogether. It's your choice. We've made the home buying experience as fast, simple, and awesome as possible for countless others, and we'd love to help you next. Get pre-approved today with the experts at Guaranteed Rate Affinity, and let's get you home.